Welcome everyone to Jim Dalton's presentation on gaining an edge through nuances. It's May 13th, 2015, currently 11:30 Eastern. We'll go till about 12:30. This presentation is being recorded and we'll have it up for you at our site in a couple of hours, probably an hour after we complete the session. Okay, and if you haven't downloaded the reports, we have several reports at our website at this post to help supplement the presentation. Also, we have the presentation slides for you there. Okay, if you have a problem downloading anything, please email me. I can attach it to an email, but I believe all links are now working. And before we go on, Jim and I want to thank everyone for being here, taking time out of your day in your trading to spend some time. This will be very different than I think you've heard in the past. Intensive traders have been hearing some of this, but for those that are just here to learn, we're glad you're here, and we hope that it's a good return on your energy and your time. Okay, so thank you everyone for being here. And with that, I will turn it over to Jim. Hi, Jim.
Good morning, Julia. Thank you. Let me start. This is not the regular presentation, but let me just do an update on the S&Ps, and then we'll go into the formal presentation. One of the things we talk about in the formal presentation is anomalies. A prominent or very prominent point of control, which you're looking at right here, is an anomaly. Anomalies have a tendency to be revisited. They don't always have to be revisited in the first day. However, today when the market opened and traded above the anomaly, a very prominent point of control, and it always raises a flag because the odds are so good that the market will eventually return to that point of control. And you can see that is what the market has done today. There were some questions early on. Overnight inventory was long. There were some questions that why the market rallied early. So many times when overnight inventory is long, we get a counter auction that corrects overnight inventory. It didn't happen immediately. Part of the reason is when the retail sales reports and import-export prices came out, the market tried to sell off, but there was a knee-jerk reaction because it took the dollar down and bonds rallied. There was an immediate knee-jerk reaction that this was going to delay the Fed. So that triggered some short covering in the market, just an emotional reaction. Once that emotional reaction had run its course, the market did come back down and trade at the point of control. As we stand right now, we have a poor low, but unless we get more downside continuation, value is turning out to be overlapping to higher so far today. It's a very poor looking day, a low confidence, but you'll see more of that as we go through the presentation. Okay, so that's the update where we are right now. The market is one time framing lower. We had an inside bar in B period. One of the standard trades is to go with any breakout from an inside bar, and that started one time framing. There's C period, D, E, and now D was narrow. E is inside D with about 6 minutes to go. I'm sorry, it just started. So we're going to see if we can one time frame lower, or if we're going to go back to a rotational mode. This is not a high confidence break on this market. It's an extremely low confidence break, as a matter of fact. Okay, I'm going to go to the more formal presentation. Okay, the first thing, gaining an edge through nuances, and this is anything that you excel at. The real expertise comes in understanding the nuances. I've told the story before of the internist that I have in Scottsdale. My daughter got me in contact with him when I had some problems, and it turns out to be really good. They just came out with the best doctors in Phoenix, and I saw him in the publication 3 times. But the reason I'm saying that is, here's a guy that is an expert, at least other experts see him as such. He asked me one day what I did, and one of the comments was, well, I wrote a book. He said, well, on trading, he said, it can't be worth much because anything like that's all about nuances. I just kind of chuckled at the time because I focused so much on nuances. I didn't bother to say anything more to him, but I did record the comment. There's a professional and he understands the importance of nuances. Examples of nuances are as follows: gaps, overnight inventories, anomalies, 45-degree line, weak references, poor highs and lows. What do they represent? Halfback, rally highs and pullback lows, and values. Now, in a short session like this, we can't go through all of these, and but we do through the intensive. We go through all of them. But I want to do is start with a few of them and give you a taste of the importance of nuances and how we employ them. One of the first ones you saw was gaps. Now, I have mentioned to traders in the last 6 months, I have come further in my trading than I probably have in the last 10 years. And there's just some breakthroughs, and most of that breakthrough surrounds better understanding of weak references, weak highs, weak lows, combined with poor highs and poor lows. But another place, initially, we talking about gaps, and we said a gap represented a change in thinking. And now I'm tapering that somewhat, or cutting back on that, because I've done more work, and we find that gaps in a balancing or trading environment are quite different than gaps that occur in a trending environment. In a balancing market, gaps very often are emotional and not lasting. The same gap in a trending market has a tendency to accelerate. If the gap is to the upside, the market's moving higher. The gap has a tendency to accelerate the move to the upside, and the market is not as quick to correct those gaps as it is in a balancing or trading market environment. What you're looking at in front of you, you will see there was 1, 2, 3, 4, 5, 6, 7 gaps, and most of them were reversed the following day or within a relatively short period of time. And that also has happened recently. In the last 26 or 27 days, we've had, I think it's 5 gaps. All of those gaps have been taken back in within 2 days, most of them the same day or the following day. So it's a whole different environment in there. Like I say, in a trending or balancing market, gaps are very often just emotional responses, knee-jerk reactions from short-term traders. And that's to be more expected in a balancing or trending market. It's a low confidence environment, and what balance is saying, when you have a balanced situation or a balanced market, the market is telling you, I need more information before I make my next directional move. So anytime there's a little piece of news or rumor comes out, there's an immediate, oh, this is it, and the market jumps. But unless it's for real, and in that environment, we take it back very, very quickly. The after effect following a gap in a trending market is we've just covered this. You see it's written there if you want to go pull it up. And you see in a bracketed market, it's quite different. So we made the slide. If you want to go back and review it, you do have the slides.
Also,
trader comment with regard to gaps in.
Excuse me, Jim. It's also, that's why we gave them the May 11th S&P recap and preparation report. So the gap conversation is on page 2 of that report. Thank you.
Okay, thank you. One of our very interesting clients, Todd. Todd is a stunt pilot as well as a commercial pilot, and he's done quite a bit of training of pilots. As Todd has reported to us, when he first joined us, he was not profitable. The next step, he became break even, and following that, he has reported that he has become a consistently profitable trader. And I thought his comment the other day was good. This is following the article on gaps that we did, I believe it was a week ago. You did it again. I have studied your work thoroughly, as you know. However, your write-up regarding the different contexts of gaps being in a trending market versus a bracketing market had not occurred to me last week. It's impressive to me after all this time, effort, and energy that I've worked on learning your teachings that you can still make me think about things in a way I had not considered for a long time. That is what a coach or a mentor is supposed to do. Continually spark your imagination and continually give you things to reflect upon that can help you advance to the next level. Todd, thank you for that comment. I'm going to start now and kind of put this in a little perspective. See the recap report from the other day. Matching, would be the recap and preparation report that goes out on the evening of 5/11 to prepare traders that are part of the intensive for trading on the 12th. First, we pointed out matching daily highs from May 8th and May 11th. So they're matching highs, so it means they're poor. There's no excess. A poor high from May 4th. So we had 3 poor highs up there. The POC did not migrate lower with price during that day. So again, it really wasn't a particularly weak day on the downside. So we didn't have any excess on the highs. Point of control did not migrate lower as it would on a very weak day. We had a 45-degree line. We're going to talk about that a little bit more. That's an indication that the market was too short. And the volume, the market was trying to trade lower. The volume was the lowest in weeks. So we're coming in to that. We're coming in fairly positive, coming into the morning of the 12th, looking at the market-generated information. Now, overnight, inventory is short. There was quite a sell-off overnight, and we come into the day with short inventory. We know that about 65% of the time, we see a counter-auction to short-term inventory. However, what is so important is to be able to understand the context in which that short inventory occurred. In this case, the short inventory occurred against a market that had trouble going to the downside, had a 45-degree line, was an indication that the market was short, got short, trying to go lower on the 11th, and therefore, when we get overnight inventory short, we have a lot of short inventory. So let's take a look and see what happens. So the overall market is not overly, well, this is the comment I made in the morning after seeing that the overnight inventory was short. So my comment on the morning report, people are part of the intensive, they get the recap and prep report that we put out the night before, and then we update in the morning prior to the NYSE opening. Context, the overall market is not overly long. Now that was a little confusing to some people. The reason I made that comment, it was not overly long, if in fact overnight inventory is short and the market appeared to have been overly long, then the odds of having a correction to overnight inventory are greatly reduced. In this case, I pointed out the overall market is not overly long. Short-term inventory is short from Monday, which increases the odds that overnight inventory, which is already short, could see some recovery. Then we wrote downside gap. Gap trading rules apply. Very briefly, the gap trading rules, and remember a gap is a nuance, gap trading rules go with all gaps that aren't filled fairly quickly. Any gap that is filled, if value doesn't become at least unchanged, the odds of a later break are relatively high. A late break in the afternoon are relatively high, particularly if this gap is coming from the downside gap. Okay, so that was the situation we had coming into yesterday, and I wanted to do these. We had canned slides we could have used from a past presentation. We wanted to put together a presentation that related to the current market as close as we possibly could, So yesterday, here's what the market looked like. There's overnight inventory. This is where the market's going to open. This is where the market opened yesterday morning. These are the points, the bullet points we were talking about earlier. A poor high from the 4th, 2 matching highs up here. So from May 10th and 11th tell us that there's no excess up here. There's the 45-degree line right here, and very briefly, 45-degree line. This is the fairest price at which business is being conducted, the point of control. And when traders continue to sell the market below the point of control, they are getting short at poor prices. When traders are selling, so they're getting short below value, or what we call short in the hole. So that gives us some of the context of what this market looked like prior to the overnight inventory being 100% short. So the market opens at the 2090, going to open at 2090.50. The immediate opening, the market opens right on the high and it immediately trades off. Notice it does not get the overnight low. It does not get the overnight low. This, you're going to see some chat comments here in a minute that I made yesterday morning. So we have the opening, 10:01. This is the last price at 10:01. Notice that the overnight low still has not been taken out. And right here, if you see the AB, there's half, the white line represents half back. B period went exactly to half back. That is a mechanical reference, a mechanical selling point by short-term traders, day and short-term traders. It is not on that level where longer-term money has a tendency to sell. When I see selling that takes place from exactly half back, that is usually an indication that that selling is taking place by the weakest of traders, and it's by the weakest of traders, the odds are greatly increased that we will come back up through that reference later in today, and if not today, I'm certainly going to be looking at it in the following session. But more often than not, we'll come back through it on that particular day. So use 10:01 a.m. last price, and I made a comment at that point. These are some of the comments that I made. 952, rejection off of the lows feels solid. If there is to be more recovery, we will stay above 1/2 back at the 2085 level and take out the early morning high. 10:01 a.m. The early volume was mild relative to the gap. The last rally was to exactly 1/2 back. I'm cautious on the downside. However, I don't want to fight the daily trend. 1/2 back in the opening are still my upside references. I'm just not that negative on this market. Okay, so I didn't clearly know what to do at this point in time. However, I did know I did not want to be short this market. Even if the market went down, I didn't want to be short. The odds were too much against me based upon what you saw written from the previous day, from May 11th, and then followed by the more recent comment you saw that the market traded to exactly half back. Again, that is not something that gives me security that I'm looking at strong selling in the market. You see what happened later on. The market, remember we put half back changed. This half back was right here. Okay, the market came back. We got several points. We came back through half back. Also, B period was an inside bar. We just showed you on today's profile, before we went to talk from the slides, we showed you we had an inside bar today, and the market broke to the downside. Yesterday we had an inside bar. I'd already made the comments about the market was short, and you see the upside from, you see the rally from there. The C period rally comes out pretty hard. And what is taking place in this example is you're getting the short covering from overnight inventory, as well as you're forcing some of the shorts relative to positions traders took home on the 11th. G period matches the D period high. So you see these two highs. That is one tick shy. See the red line? The red line would fill the gap. D period is one tick shy of filling the gap. One more time, that is a weak reference. It is a good high at this time because there's two single prints, but it is a weak high because it is a single print from unchanged. Again, longer term, stronger money isn't going to wait for one single tick to fill the gap before selling. Who would sell a mechanical reference like that? The people would sell in a mechanical reference like that would be the day and short-term traders. Once again, those are the weakest of traders. And by weakest of traders, I mean they are the traders that are more emotional. They are the traders that are more likely to reverse their position and panic out and come back very, very quickly. So now, remember early on, this is a weak high because it is a single tick below filling the gap. It is, however, a good high because it has two single prints. G period comes up, G period comes up and prints exactly with D period. So now we have a combination. We have a weak high and a poor high. So the odds of that being taken out have improved substantially. Well, the first thing traders do, there's automatic selling at the highs. In the early period, the market trades off in H period first. Automatic selling, mechanical, non-thinking selling at the high. When you see this happen, more than likely it is setting up an opportunity to come back through that. In other words, it gets the traders short, and the chances are pretty good we're going to take that high. Remember, it was both weak and poor. So you got a little automatic selling in H period. Traders automatically selling the high, and then the market comes back through and takes out that high. So they got those stops. That's all there was at that moment in time. But this was not a good high in there. We come out and take it out. Then the rest of the day moved pretty much sideways. I had to go a doctor's appointment yesterday afternoon. I put out another comment on the chat. What we do on the intensity, there's a one-way chat. I make comments throughout the session on what I think of the market. And at this point in time, I looked, and most of the activity was taking around the 2095 level. It just looked to me like the market was balanced, and I said, well, I have to leave. I'm signing off, but it looks like the market is probably going to balance the remainder of the afternoon. It did that. It tried up, it tried down. Basically, it did balance. Now, remember, earlier on, we talked about the gap trading rules. One of the gap trading rules was if the value doesn't become unchanged or overlapping the previous day's value, the chances are pretty good that you're going to get a late break. Now, that late break doesn't have to be a dynamic late break. It's just that you're going to get some late liquidation in the market. Why? Because value, even though we filled the gap, overall value was lower. So the gap rule applied. So when we recap this, you have all kind of information in here. One of the nuances, overnight inventory was short. We know about 65% of the time there's a counter auction to balance overnight inventory. Then we go to another step. We said, okay, let's refine the times when overnight inventory is corrected. And as we refine it more, we use context. And we refined it more. We said the context was that the previous day was not overly long, so inventory wasn't overly long, and it looked like inventory was short from the previous day. So that information gave us a pretty good idea that we were going to get a recovery from overnight inventory. So that is what happened. We looked at another one of the nuances we're talking about, are weak highs. So we saw this nuance of this weak high, even though it was a good high because it was two single prints. And we said it's a weak high. What's a weak high mean? It means that the odds of coming back through that are fairly high as the day goes on. We saw another nuance, which when we came up and we now have a poor high. So we have a combination of poor high and a weak high. We saw nuances come into play again. We saw a final nuance in the gap trading rules. If a gap is filled and volume and value doesn't become overlapping, then the chances of a late liquidation are pretty good. So most of the trading yesterday revolved around understanding nuances, and not just the nuances, but the context underneath those nuances. And let me give you, for those, I know a lot of you have heard a lot about the intensive, or you're members of the intensive. Some of you have not. Let me give you a little background how we came to do the intensives. We were doing a seminar in Chicago, and it was a pretty good seminar. It was one we got very lucky. We had some really unbelievable things happen to us. But when we got done talking to Julie, and I was somewhat frustrated because I said, you know, even though people loved the seminar, we got good results, and we were very fortunate. You really can't cover enough material in, 3 or 4 days. You can cover a lot of material, but one, it's hard for people to internalize that. But additionally, you're only going to see certain kinds of markets. Julia came up with the idea of the intensive. So over intensive, the first one we did was 60 days, and 60 days was just too hard on me. So then we did 30 days. Now what we're doing this time, it's a 30-day intensive starting June 1st. However, the earlier you sign up, we are doing the daily reports each day, and we're doing the one-way chat each day in order to better prepare you for the intensive that starts on June 1st. So much of this revolves around nuances and understanding the context surrounding those nuances. Now let's just take a fast break. Let's go back and let's see what's going on in the S&Ps today. Okay, we looked today, when we left the market, we talked about the the C period broke out to the downside from the inside bar in B period. We got back down to the prominent point of control, which is another nuance. It's also referred to as an anomaly. That was corrected. We have a poor low down here, so it's not a high quality low. And at the same time, we did not continue to one time frame lower. So the market, later in the day here, the market is continuing to move sideways and balance. Overall, value so far is overlapping to higher. Now we'll do more volume analysis a little bit later. Okay, let's go back to our presentation. Okay. We've talked about walk up to May 12th, nuances, anomalies, and structure. We already talked about a poor high from May 4th. May 5th, we had a 20-point down day, multiple anomalies, and we're going to go see this. We're going to see this. I'm going to talk about it first, and then I'm going to show you the graphs. So On May 4th, we had a poor high. May 5th, we had a 20-point down day, multiple anomalies. Multiple anomalies suggest emotional selling or what we call forcing action. We had on May 6th, we had a 45-degree line. We just saw one of those before. Excess daily lows forms more anomalies. We'll see this in graphics in a minute. P-shape indicates short covering. We'll see that in a minute. And gap higher, all shorts hadn't been covered. Now, let me go to the actual slides and talk about those same points. Okay, you see on May 4th a poor high. When you see a poor high, that's an indication that there was no aggressive selling at that point in time. You also see a very prominent point of control. Very prominent point of control have a very high probability of being revisited. If they're not revisited immediately, then you're probably going to see it down the road. Now, we've covered some of this on a previous presentation, but I wanted to go back over it again because it is so important. Nuance. This is a weak high. Notice that high went exactly to unchanged. The green circle is unchanged, followed by the single print. So it's a good high because you got all those single prints. It's a weak high because it was exactly at a number. Now, we talked about major nuances or anomalies. When you see the anomalies, and anomalies are nothing more than jagged edges to the profile. Anomalies generally represent that you are getting forcing action or liquidation or emotional selling. What they suggest to you when you're going down like this, when you have this many anomalies, it is suggesting that your selling is by short-term traders and liquidation. It is not the more potent combination of new money selling and liquidation. And it's so important because what happens to traders when they see the price go down, they immediately think, oh boy, this is longer term money. This is really serious money coming in to sell the market. Again, you have to look at the context. Now, follow through. This is the last of the 5th. On the 6th, the market does continue lower. So even though we've got all these anomalies, the market does continue lower. Notice we get more anomalies on the 6th, but more important, one more time, here is the 45-degree line. The 45-degree line, the fairest price, it's the point of control. Another way to think about the point of control, it's the fairest price at which business is being conducted. So you combine a poor high from the 4th, all of these anomalies, and finally on the 6th, you get a 45-degree line. Again, these traders, these are the laggard traders. They're selling short in the hole or selling continually short at prices below the fairest price for the day. Now, the following day, you get a short covering rally. One of the footprints of a short covering rally is a P formation. And why do you get a P formation? It's another nuance, but it's important to understand. Traders get terribly misled by this formation. The P formation is an indication that you are getting short covering, meaning old business, but that old business is being met by new money selling, not necessarily strong money, but by new money selling. So if you had a combination, if this rally was a combination of short covering and new money buying, which would be far more potent, it would be elongated. Instead, this rally from short covering to old business is being met by selling from day and short-term traders that are now conditioned to sell every rally. They've seen the market go down fairly big for the last couple of days. Now, understand, the problem is they don't understand the context. They don't understand the context of how short this market is based upon the anomalies that you had on the 5th and the additional anomalies you have on the 6th and the short covering rally. They don't, all they're thinking about is price. Most traders that are not successful because they can't get away from focusing on price. Price is nothing more than an advertising mechanism. It is the context underneath that price wrapped around a lot of nuances that really do help you understand what is going on. So at this point in time, there's a short covering rally going on. The shorter term traders that saw this market go down the last couple of days, they're very excited to sell into this rally, which is why it's not going any higher. And it also has a poor high. Now, here's what most traders mistakenly want to do is they want to short this rally. They see this and they say, they think it's an aha moment. They see the P formation, it's short covering, and we know, well, I haven't mentioned it yet, but short covering can actually weaken a market because it removes that potential buying power of the shorts. However, if you think about this, see how far down this market has come on the 5th and the 6th, and you get a short covering rally here, that certainly is not enough short covering to take back all the shorting from the last 2 days and based on the anomalies. In fact, one of the best people that I've ever known for reading this is Julia. I can hear her saying so often as they're trying to rally on this day and they're selling into it, and I can hear her saying, all the short-term traders are doing is adding more fuel for more short covering going forward. So now there's the 45-degree line. We talked about that before, but I just wanted to show you what a 45-degree line looks like in another sense. It's as simple. There's the fairest price at which to do business. Traders are selling short in the hole or selling at very bad prices, and they're going to get panicked out of it in most cases. Now, what happened following this short covering rally was a 12-point gap on May 8th. Now, we started talking about gaps, and then we said we went to another level in talking about gaps, and now it's so important to understand the context behind the gap. On this gap, the market did not take back any of the gap. The market opened, went just a couple ticks lower, and it spent the rest of the day trading higher. Why did that happen? Go back and understand the context that the market was terribly short from the 5th and the 6th. Short covering rally on the 7th. But as we said, you can hear Julia saying the shorts are selling into this. They're just adding more fuel for the shorts. And then you get the short covering rally that takes no prisoners and no give back on the 8th. Again, there's your P formation. You had this massive short covering rally. You've now taken back all of the shorts from the previous time, and so the market's no longer short in there. So that's what happens. Now, it takes a lot to understand it, and it takes a lot if you don't understand the underlying context. The gaps and the price will just scare the daylights out of you. If you understand the underlying context, it will make all of that much more understandable, and it'll make you much more comfortable trading with it. And this is our intent as we go through the intensive. This is what we're trying to do, give you a deeper understanding to get you away from just thinking about price, understanding the nuances, and understanding so much more about the context of the market. Again, Julie just put a slide in there to show you what was going on, and now you go back and see the comment, we got the shorts covered, and you see when we come up to May 5th, the market was, or to May 12th, the market was not overly long. There's the 11th. This was the day before yesterday. And remember I said yesterday morning the market was not overly long. And so when we gapped yesterday, if the market had been overly long, been a better chance that we would not have filled the gap. We did fill yesterday's gap. So the short covering, remember, short covering can weaken a market because it takes potential buying out. So we were off the next day, and then we gapped lower yesterday. Of course, the gap was filled. Okay. Gaps are gaps, but context changes the auction odds. We've reviewed those, and you can see that slide. It's the context prior to that slide, prior to the gap, that helps you assess the odds of what's going to happen following the gap. Okay, a review of the nuances. Gaps, we talked about gaps. Overnight inventory, anomalies, 45-degree lines. We talked about weak references. We talked about poor highs and lows, and what do they represent? We didn't talk about halfback or rally highs and lows. Value is a constant discussion of what we talk about. So, but all we could do today was just, touch on this idea of nuances, the importance of it. In nuances, when you get below the basic surface of a market goes up and a market goes down in the two-way auction process, when you get below the surface, you start uncovering the nuances, and the nuances are what will allow you, understanding nuances and being able to trade around them, are what will allow you to become a successful trader. Okay, Julia, I'm going to go back. I'm going to take a fast look at today's market, and then let's open this up for some questions. Okay, before we do that, today's market is continuing to balance. We had a short covering rally early this morning. We had a liquidation break. We came back to yesterday's point of control, and the market is just basically moving sideways and in a balancing formation. So this market has gone nowhere for 28 days. We have been in this very tight trading range. There is no indication of long-term money on either the buy or the short side. It's just a really difficult market. It's actually been a pretty good market for me to trade. It's a difficult market if you are looking for continuation from one day to the other. If you accept it's a trading environment, and there's been some good opportunities each day. Okay, Julia, let me take a few questions, please.
Yes, that would be great. Thank you, Jim.
Julia, you there?
Yes. Can you hear me? I'm on a different mic today.
Yes.
Okay.
Okay, I can hear you.
The context of trades, let me just get to Robert here. Trades based on context anomalies. Could you comment on the various options for taking a trade based on the contextual situation? In other words, aggressive versus a more conservative trade. I mean, for instance, this morning, we looked above. Can you pull your profiles down a little so we could see the whole day? We looked above the overnight high. We came back in. Everyone has seen the morning report. Jim talked about the prominent point of control. If we do not revisit it and we go higher, we're likely coming back to come at it and repair it. So when you look above, we had several traders in the intensive who emailed us and said they took this trade, looked above the overnight high, knowing that the point of control was still out there, hadn't been repaired. Is that a aggressive trade? Well, it's kind of tough to step in front of it when it's pushing up like that, but knowing your risk tolerant, knowing it's an asymmetric opportunity, makes it a little more doable.
No, let me comment on that. It is not an aggressive trade because you have a very realistic place and a tight place to place a structural stop. So if you look above the overnight high and come back in and you place your short, your stop is someplace right at or just above the morning high. So you may be risking a couple of handles, but it's not an aggressive trade because your risk is so limited and the reward has very high potential to it. So it's how, remember, one of the things that we focus on a lot, you can control risk, you cannot control return. A good trade to me is a trade where I can fairly closely identify my risk. Then I can decide, is the risk that I need to take, is that acceptable to me versus what the potential for that trade may be, even though I don't know how far it can go. But when I come back in above the overnight, we always say that the overnight high and low are consistent day and short-term references. So looking above the overnight high, coming back in, placing your stop right at or just above the overnight high, limits you to a couple of handles risk. That is not an aggressive trade. Now, here's another trade. The B period, inside bar. It's one of the classic signature trades, inside bar, and you come out of that inside bar, that's a very legitimate trade. Excess and balance are the two most important concepts we ever deal with. And so coming out of this, going short and putting your stop back up in here, that's not an aggressive trade either. Again, what I define aggressive versus non-aggressive has to do with, do I have a place to reasonably put my stop? Based on structure, not based on price. Putting a stop based on price is killing yourself, because that's just an emotional thing. I'm willing to take X amount of risk. The best way to do it is have some kind of structure to lean on. Okay, additional questions, Julia?
Yes. The 45 line, Jim, we have a few traders asking about it. Would you be so kind to split out 511? We could just quickly, because they're saying, well, isn't it to the top, or what makes a 45 line? It's not necessarily the angle of the line. It's the nature of the price action, where it just comes up, goes down, comes up, goes down, but it's drifting lower, and the point of control is not migrating with it. So all those traders, think about it. J and K and L, M keeps trying to come back up, but they're selling below value, and the point of control is widening out, and it's not going lower. So it's really just the nature of how it forms, not necessarily the angle itself. I don't know if that helps you, Rick, but
it starts with understanding. Don't think of this in terms of point of control. Think in terms of it as being the fairest price at which business is being conducted. If the point of control is right here, early in the afternoon, and then it migrates down, say the C period low later in the afternoon. All right, now the fairest price for a business to be conducted is gradually moving lower. It's gradually moving lower, so therefore there's some real selling pressure on the market, at least on a relative basis. When the point of control does not migrate lower, and the market, as Julie said, it trades off at rallies, and that doesn't change, traders are consistently being emotional and consistently selling price and not having any cognizance of the idea that they are selling below value. Now, that you don't always lose. You don't always lose. This market, went substantially lower overnight. There were some other things going on, and the market has to take care of current business first. However, we talk about carrying information forward. This trade, the market was getting very short. So understanding this, while it didn't help a trader this day, it certainly conditioned me not to get sucked into the gap lower the following morning. And you saw that I put out the chat comments as I just can't get overly excited on the downside of this market. And you see the market comes back fairly close to that level. To the previous day's low. So the gap was filled yesterday. It didn't make this point, but it did take back all that early morning gap that was substantially lower. We were way down in here. and we took all that back. So that information was very helpful and not allowing me to get trapped on the wrong side of the market. Okay, another couple of questions.
Can you clear that, Jim, cancel that split out profile and just slide it over to the right so we can see more? Michael, let me get this in. Yesterday we have a P formation suggesting short-term sellers were selling into the rally. Okay, so just point to yesterday, Jim. Okay, so now we have had a move up to clear those stops, and now looking like it's a B formation, which shows weak buyers buying into the selling. Is this correct? What does this mean then in a reversal in mindset in the market?
Don't try and make a science out of this. We are in a range from the 2119 level to the 2062 level. And if I start from right here, I get, what is that, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 17, 18, 19, 20, 21, 22, 23, 24, 25. I think it's almost 28, 30 days. There's nothing going on in this market. We gapped, let's just take a look at this market. We gapped higher, we filled it. It's a daily. There's really, we gapped higher, we filled it. We gapped higher, we filled it. There's nothing going on in this market. Trying to make something, people want it to be more scientific. They want to see more continuation, and it's a nothing market. You're in a range, what's that, 38 handles from 62 to 21, 38, and call it another 12. So you're in about a 50 handle range, and you're not too far from the center of that range. There's a tremendous amount of confusion and uncertainty out here. There's nothing going on in the market. So much of what we're doing is just trading from day to day. Okay?
Great. Okay, thanks, Jim. Does Jim feel the market is still net short from Monday? As we have not repaired a lot of those weak and poor references, we wouldn't be repairing, well, we'll leave it at that. Does Jim feel it's still net short from Monday as we have not repaired a lot of the weak and poor structure?
I'm just neutral. I'm just treating the market as neutral.
Okay.
Yeah.
This morning's price went down to a tick below Tuesday's end period low. Is N too late to be considered to be the afternoon pullback low? And
No.
was this a rational place to look for a turnaround? Want to split that out so we could see the end period, how it traded? Thank you.
Okay. This is one of the nuances we didn't cover. Afternoon pullback low, it is another nuance that we use. Afternoon pullback low on an up day, rally high on another day, and I don't think it's an accident that the market stopped there today. Again, remember, if you had anything seriously going on in this market, you're not going to automatically stop right with one of those references. All we have in this market is trading money, and it's going from rumor to rumor, report to report. There's really no confidence in this market. It's trading money, and you need to just to understand that and not make anything out of it. So I do think that this was a logical place this morning. If you were short, it was a logical place to take back a short. I don't necessarily, even though the market went up, I don't think it's a place to go long because it's not a particularly strong level. Okay, good question. Other things.
Jim, since we have a good high today and a poor low, are the odds we're going down again today?
The odds are we'll take out the low. The odds are we'll take out the low. I'm not sure the odds are good that we go substantially lower because we've already gotten, you've already gotten five wide up in here. You could balance. Again, just understand this market. There's just nothing going on. Any rumor could send this market in any direction, any point in time. Let's go walk over here and take a look at, okay, bonds. The market softened a little bit because bonds were up this morning. The market rallied. Bonds are soft. The markets backed off. Again, not that that's rational, but that's what the market's doing. The dollar index there was a time when the dollar index was off, it would have the opposite effect. Now the dollar index is down, and that can weigh on the market. It's depending what the traders want to do with it. It is a low confidence environment. I will go back to say there's no excess on the highs. There's nothing substantial on the lows. There's just nothing going on. But to the direct question from this morning, yes, there are better odds that we take out the low, but the odds aren't particularly good that anything can happen. I mean, if you do take out the low, there's anything on the downside, you get the double distribution day. In other words, you blow this distribution away, and then you leave quite a bit of space in there. But, again, it continues to be an extremely low confidence environment. That is a weak low. There is no excess on it. Okay, additional questions?
Do you think there's a chance for an outside day?
Again, that's one of those grandiose questions. People, something in their mind, an outside. Yes, there's always a chance for an outside day, but it's certainly not a high odds play. If it happens, it happens. I'm not going to play for it. We've gotten fairly wide up here. But understand, anything can happen in this market environment. It's a very thin market. You just saw over there that bonds were off. Bonds were off 20, and that has not been positive for this market.
Where do you place your stop on an inside bar breakout? Could you slide your profiles down so we could see more of today? Thanks.
It's, again, there's no science to it. Someplace back up in the bar. I mean, people are always looking for, remember, exactness kills. You want the breakout, and you really don't want it to come back up in here very far. I don't know exactly where you put the stop. I really don't.
Some traders will use the half back of the individual 30-minute bars, as you see Window Trader has marked. I've seen traders do that, but, And
incidentally, it's another question on risk. I mean, if I have a wide inside bar, I am far less inclined to take a breakout from that wide inside bar than I am from a narrow inside bar. The narrow inside bar will allow me to put a fairly reasonable structural stop. A very wide bar, the stop may have to be considerably wider. So I prefer just a nuance, I prefer a breakout from a very tight inside bar rather than from a big inside bar that covered a lot of distance.
Jim, the E period high, when it bounced there off the lows, it came right to the opening price. Do you see that as a weak reference?
Yes, I do.
Yeah, and I had commented back that we went 5 wide as well, and that we still have the poor low. So it's one data point among many.
It's a weak high. It went to the opening. It went to, it went exactly to the opening. That's a sign of weakness. Poor low. That's a sign of, it's just.
It's such a low confidence environment right here. Yeah. We're in the middle. 2090 is the middle of the 26 plus day trading range. So we've got just a wide bracket, and now 2090 being the center of it, we're in the middle. So there's a lot of things going on, but they're kind of canceling each other out. Net, nothing's changed.
Okay, couple more questions.
Let's see. Yes. Okay. All right. Jim has brought a new way of thinking with this revelation about weak references. Really good stuff. My question, would Jim consider a prominent POC reference a strong reference, or would that still be weak? Or maybe a medium strength reference? It seems a strong point of control, or I think he means predominant or, particularly wide, would definitely be a stronger reference. And have a better place to take a trade.
A strong reference to me means that if we get away from it, the odds of it coming back to there are very good. So I'm not sure about the term. If I had, I don't think I would classify it as a reference that has a high probability of being revisited. And it's going, the more prominent it is, the higher that probability. I don't know if I would classify it weak or strong. A high or low, I can classify weak or strong. Point of control, I'd rather think of it in terms of the more prominent it is, the higher the odds that it will be revisited today or in a relatively short order. Maybe a day or two later. Okay?
The sellers that sell the inside bar breakouts weaker participants?
They're traders. They're probably, it's not, it's more than likely not longer term money. It's more than likely, daytime frame traders, but they can be smarter. Remember, you got a whole series of day and short term traders. Some are pretty sharp but have a lot of money. So somebody that, can maybe sees that coming and goes with it, they may be pretty sharp. They may say, okay, the market's balanced. Let's go with this thing. And so the early traders, very often, they're probably fairly sharp. But remember, it's trading. It's the overall. When I talk about what I'm always looking at, I'm saying overall, do I appear to have any new strong money in the market? And if I see I've got new strong money in the market, it would be like a trend. Now maybe I'm going to get some continuation. And when I don't have new stronger money in the market, or at least I don't see any indications of that, then it helps me know how to trade it. I'm going to trade it much more short-term oriented. I'm going to think the way the short-term traders do. I'll think about half back, which we know is a classic reference. I'll think about the openings. I'll think about the previous day's highs and lows. When the longer-term money's in the market, they don't even know where those things are, nor could they care less. So it helps me when I have some assessment early on of who's trading the market. It has me a pretty good idea what references they're going to use and how they're going to act. And that's a key. That's a key because one of the things that we stress so much in the intensity is learning to trade by understanding those that you are competing against. And so many times you will see that the people you're competing against get the markets all out of line. And there's times when you want to go with them. There's other times when you want to fade them. There's times you may go with them early, fade them later. But you really understand the position they're getting themselves in. For example, with the very prominent point of control from yesterday, overnight the market was substantially higher. And, talking to Julie this morning, what did I do? I bought puts over here last night. I bought puts over here with the idea we'd come back to this point of control. We didn't make it all the way back, but the market was fairly clear, gave me a really nice trade. And what am I looking at? What happened? The weaker traders, all they did was get inventory just very, very long. Very long. Then they brought it back all the way back to just a couple of ticks below unchanged early in the morning before they rallied it again with the with the reports this morning. But understanding that, the people I'm competing against, they've got themselves dangerously long or they've got themselves dangerously short. It doesn't mean you're going to get an immediate reaction, but it's certainly helpful when you say, I don't want to be in that position. I don't want to be with them in this case. I'm ready to fade them.
Okay, and speaking of that, if F period, and he asked this, 5 minutes before we flip to G, if F period stays an inside bar, what direction would you expect the next bar's move?
I don't know. I mean, you're trying to put too fine a, the low is even worse. The low is even worse than it was before. You're trying to put too fine of a point on it. You just got to be able to go with the flow of the market.
It's interesting they've been able to defend that low there. I mean, you would think they could have taken those stops and run it down, but each time it's come down, E comes close to D, F comes close to E, and now G, they get a bounce off of it. But I certainly, I don't know. I wouldn't want to be long. It feels like it's got to be taken, or they could go get the stops. But it's just interesting how they can defend these levels.
Because there's nothing going on.
Yeah. Tells you what we're trading with.
Short. Remember, let me show you something. We talked about this before. Remember I said yesterday, D period, one tick shy of the previous day's low, made it a week low. G period exactly matches this, makes it one tick shy of the filling the gap. It also makes it a weak high as well as a poor high. What did the short-term traders do? They immediately came up to G and they immediately sold it off. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, almost 2.5 handles. So they immediately sold the market off. Did they know what they were doing? No. Look what happened. We came back in that same period, stopped them all out. So it's when there's nothing going on, they can get a lot of trouble in there. Mm-hmm. And that's what we got today. We've got nothing going on in here. Remember, I did say earlier, somebody's talking about, can we get an outside day? I said, I'm looking at this, it's 5 wide already here, and it makes it hard to get too far away from there. Anything can happen, but, we've come back there. Again, there's times
6 wide. Yeah,
there's times you have to accept there's nothing going on. Traders, and I've said this over and over again, if you're out there looking for a trade, the harder you look for a trade, the greater the odds you're going to find that trade. The greater the odds the trade's no good. And I get this all the time, traders looking for a trade. How about this? How about that? How about that? When the good trades come up, they'll just kind of speak to you. You have to understand the market first. But the harder you look for the trade, the more likely you are to find it, the more likely it is to be a poor trade, because the more likely it is it's an impulse. When you're looking for a trade, if you're doing that, get up and take a walk. And I seriously mean take a walk. Break the spell. Get away from the market. All right, final question.
Well, someone's asking, as the value is, getting more overlapping, and value is drifting slightly lower, does that change your perspective, or think he's asking even for the outside day? I think you pretty much have already answered that, but just as the value assessment, as it seems, is drifting lower, does that change your perspective at all in terms of how to navigate this afternoon?
No, value is overlapping to higher. It's going to take, to get value to be overlapping, here's yesterday's value. To have value be overlapping to today, you're going to have to take this out and get some serious range extension and a double distribution day. Okay, one more time. We start on June 1st for the intensive. And if you're interested, sign up immediately. The intensive, you get 2 reports. You get the recap and preparation report every day. You get a morning update. I do the one-way chat throughout the day. You saw some ideas and messages I'll put out on that. Somebody's at my door. Hold on just 1 second, please. Julia, why don't you finish that and I'll answer the door.
Okay. All right. Thanks, Jim. So, and then you get the one-way chat, and then we'll start the online sessions. So if you like what you see, it's a lot to absorb. We know that, but really when you come out of the intensive July 2nd, you will have a completely different perspective than how you came in. So you'll pick up on nuances and that sort of thing. Alan, let me ask you a question here. I know we are 5 wide, but short-term traders can get very... Are you back?
I am.
Jim, quick question. We're cool with the intensive and all. I know we are 5 wide, but short-term traders can get very emotional and shorten the hole in this G period. Do you take some advantage of these kinds of breaks, or the odds are low and it is better doing nothing?
I probably do nothing. But remember, I'm looking for 2 to 3 trades a day. Many people out there are looking for multiple trades a day. And, it's just not something that's, with the poor low down there, it's not something that really interests me. And what I find so many times, when the markets, if you're out there looking for a trade and you force yourself, what happens when the really good opportunity comes along, you're not ready for it because you've worn yourself out emotionally. So I'm very content I'm very content to let the market sit. You know, I always have a book here that I'm reading. And incidentally, speaking of books, I just finished a book. It's called Dark Pools by Patterson. It is really about the fast trading in dark pools. It's a fascinating book. I think everyone want to read it, and you'll find out that, you know, some of these fast trader guys, they go out of business too. They get overrun by another set of algorithms, and they get set up by another set of algorithms. And the people that are disadvantaged so many times are the big mutual funds. You know, not the individuals so much in it. But anyhow, it's a fascinating book.
Yeah.
All right. Anyhow, listen, thank you all, and we'd love to have you and join us for the June intensive.
Okay.
Julia,
yes.
thank you.
Thank you, Jim, very much, and thank you everyone for being here. Our next webinar is next Wednesday, and we'll get this posted pretty quickly for you. Okay, and if you'd like to talk about the intensive or have any questions with what we're doing, please don't hesitate to give us a call. Okay, have a great afternoon. God be with you, and great trading. Be well. Bye-bye.